Hello and welcome to Portfolio Matters Weekly Markets Checklist, week 146. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research and consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. What do we have this week, Keith?
Okay, this week we have a number of special sections. So, in a change to our usual schedule, we won't be doing Recession Watch, Inflation Watch, or Soft Landing Watch. We're going to be doing special sections on, amongst other things, repo and reverse repo and the non-farm payrolls. Normal service will resume next week. First of all, the news. Well, the big news was last Friday, non-farm payrolls came in red hot at over 300,000 jobs created in January against expectations of only 180,000. And that portrays the US economy as not only strong, but strengthening. Now, we have a special section on this coming up. And the bottom line is the US economy is strong, but it's likely that non-farm payrolls for January exaggerates the strength in the jobs market. Elsewhere, the S&P 500 has hit new all-time highs, and hence we've got a bull as this week's graphic. And that has been driven almost entirely by AI, NVIDIA, and actually it's now the Magnificent Four, not the Magnificent Seven. In China, deflation continued and deepened, but the stock market in China had a fleeting rally as state entities bought ETFs to support the market. Some graphs, well, the strong non-farm payrolls led to a repricing of interest rate expectations. So the market is now basically entirely discounting the possibility of a March rate cut, and cuts are now forecast to start in May. Now, New York Community Bancorp continues to decline its share price, and that's led to falls in the shares of other US regional banks. Now, the problem in New York Community Bank may be entirely idiosyncratic. You remember it took over the assets of Signature Bank, but the fundamental cause was weakness in multifamily residential and CRE, which other regional banks will have exposure to. So watch this space. The S&P 500 is going up in a straight line, and NVIDIA has gone absolutely parabolic. It's now on a P ratio of 92, cheap if you can get it. And onto this week's economic data. A quick summary. The UK economy is weak but shows signs of bottoming, according to the latest PMIs. The EU is weak and shows, frankly, very little signs of bottoming. The US is strong, and if the PMIs are to be believed, maybe bottoming and strengthening from here. And China, very difficult to tell, frankly. The UK, Richard.
Thank you, Keith. So UK services PMI was up for January, better than expected, and bouncing along just in between 50 and 60, looking quite healthy.
Yeah, looking absolutely fine, frankly.
Yeah, and the composite is has poked above 50, and obviously services big part of the UK economy, and so the composite is also looking quite healthy at the moment. Construction PMI is not looking so healthy. It looks like it's on a fairly steady downtrend there, and that downtrend hasn't been broken despite it being a bit of an uptick over December.
So the commentary was that new orders continued to decline, but the decline in new orders was the smallest in about 6 months.
Right. Okay. So maybe it'll level off shortly. UK BRC retail sales year on year declining and worse than expectations. And again, that is now looking on a fairly steady downtrend.
Yeah.
It's a
Reminder,
weakness for the UK economy.
last week we reported that the UK retail sales in December last year fell by an astonishing 3.2% month on month. So we're getting this picture of consumer spending weakness, even as the services PMIs turn up.
Indeed, yeah. Which is not surprising given the amount of inflation that we've had, and the wages haven't kept up with the inflation.
Yeah.
UK Halifax house price index is steadily rising at about 1%, 1.5%, between 0.5% and 1%, basically month on month.
That is amazing numbers.
Which is a lot. Yeah.
Given that we know that mortgage rates remain high, affordability is stretched. In the last 4 months, you've had price rises of the best part of 5%. Amazing.
Yeah, it is, isn't it? It's counterintuitive, Keith. And there we have the year on year now back into positive territory. And the house price balance, is that the balance between increases and reductions?
Yes, it's the Royal Institute of Chartered Surveyors, number of chartered surveyors reporting falling or rising house prices.
So obviously surveyors are seeing members of the RICS are seeing house prices starting to increase across the board.
Yeah.
Not many of them are reporting falling house prices.
Yeah. So actually, the balance is still negative, Richard. So that implies that you've got a very uneven housing market with rises in some areas, but the balance of the geography falling.
Yes, very true, Keith. And as you said last week, the data can be skewed by the fact that the houses that are being sold are the ones that people can afford to buy.
Yeah. So the rich people's homes, basically, expensive ones.
And the UK mortgage rate, base mortgage rate is still at 8%, although obviously there are deals that reduce that very significantly. And the economic surprise index is looking rather negative at the moment, would you say, Keith?
It is, and I'm very surprised by this. And, you're deeply skeptical about this index, Richard. And, when you look at the UK data, I'm not sure it's that bad, frankly. But, other regions like the EU and the US economic surprise index are doing better. The UK is doing worse. I'm puzzled.
It's astonishingly surprising, you might say. Okay. So Indeed is reporting a continuation of falling job postings, which have now dropped below their pre-COVID levels. Well, I mean, they are sort of roughly at their pre-COVID levels, and I guess you could say the pre-COVID level is the norm.
Yes, exactly.
And we have to see where it goes from here, really. UK inflation rate, true inflation, continuing to fall, now at a mere 2.4%, as opposed to the government reported 4%.
Yeah.
And Adzuna, which I've never heard of actually, so well done for finding this, Keith, is reports that the average UK salaries increased by 3.6% in January.
Yeah, I'm amazed by this. So Adzuna is another online job posting agency, and it publishes summary statistics for the UK labour market. And if this is true, that's bad for inflation. But I would add that dip it's reporting in salaries in December, I don't think is corroborated elsewhere. So I think that exaggerates it. But it looks like a lot of salaries reset in January, and that will be bad for the Bank of England.
It will, won't it? These things are always tricky on a sort of month-on-month basis, but it's interesting that year-on-year they only rose 4.9%.
Yeah.
So our summary is that UK services PMI revised upwards and looking quite strong. House prices are rising, but we think there's some skewing there in the ascertainment of that data. Job vacancies on Indeed are showing no sign of recovery, although they're no worse than they were pre-COVID. So bottom line is the UK economy is weak, but maybe bottoming.
Now, when we go through all this data, there are reasons to believe that the seasonal adjustments for January and February are still distorted by the pandemic and may be showing exaggerated strength. So bear that in mind.
Yeah.
And while we're talking about the UK, a brief piece on the UK labour force survey. Now, and we know that the response rate to the UK labour force survey has been falling, and hence the ONS has been struggling to provide decent data on things such as the unemployment rate. Well, they have just released their revised estimates for employment status, and it has substantially revised upwards its estimate of the working age population. And that has led to an increase in the number of people in employment at the top, in unemployment, and economically inactive. So that means it has revised down the percentage of people in employment, down the unemployment rate, and up the percentage of people economically inactive. And the result of those changes is that it thinks that the unemployment rate actually fell to 3.9% in November compared to its previous estimate. Now, you remember we've been reporting that the unemployment rate has been flat for the last 4 or 5 months, which we knew just couldn't be right. So the ONS are now saying the unemployment rate has been declining, and that's mainly due to people leaving the labour force, so not counted as looking for work. Bottom line, the UK jobs market was doing better than previously estimated, but is still slowing. And in the commentary, they said the number of redundancy notices received by the insolvency services rose by 17% year on year in January. Now, going forward, essentially, they're not going to be reporting a lot of labour force survey information going in the monthlies going forward, and normal service is not expected to resume until September, apparently. Until then, the Bank of England will be lacking some crucial data on which to make its interest rate decisions. And onto the EU. Well, we had construction PMIs, and those were awful. Construction activity continues to decline to new lows in the EU. Retail sales missed, down 1.1% month on month in December, below expectations, which were already poor. However, they did revise upwards the November number quite substantially. Year on year, retail sales declined 0.8%, which was slightly better than expectations, and there was a big revision upwards in the November numbers. So EU consumers not doing well. Good news is producer price inflation continues to be negative month on month, falling 0.8% in December. That met expectations year on year, down 10.6%. Deflationary forces in the EU are quite strong. And as a result of the weak inflation, EU consumer inflation expectations over the next 12 months are down to 3.2%. That should please the ECB, although they did revise up the November number to 3.5%. I'll fix that later. Now, the general pattern in the EU is Germany and France, i.e. the core, are weak, and the periphery, such as Italy, are quite strong. So if you look at the German services PMI in January, it continued to weaken, and that is not a good number. In France, it's even worse, down to 45.4, showing no signs of recovery. But the Citigroup Economic Surprise Index strengthened sharply, Richard will be rolling his eyes. So the summary is, in the EU, the core is weak, but the periphery is quite resilient. Inflation continues to slide, as do inflation expectations. Currently, the EU economy is stagnant and showing little signs of recovery. On to the US, Richard.
Thank you, Keith. So US non-farm payrolls, as Keith alluded to at the opening, and I think probably everybody knows, the non-farm payrolls figures were very, very strong. I think when you dig down into the numbers, there's the usual sort of adjustments and part-timers and so forth. But on the face of it, these are very strong numbers.
Yeah. And notice they also revised up December.
So average hourly earnings month on month rose by 0.6%, which was quite a lot more than consensus expectations. And that is an annualized rate of about 8 or 9%. I know that the average hourly earnings may be a function in the fall of hours worked, which of course is inconsistent with an increase in the number of people in employment. But anyway, here's the US hourly earnings year on year, which is showing signs of moving back upwards. US average weekly hours significantly down and on expectations. And again, this graph isn't consistent with the payroll figures.
Yeah.
I should point out we are obviously in an election year in the US, and the incumbent administration will be doing everything it possibly can to paint the economic situation in a good light.
Well, we have a big section on the non-farm payrolls data coming up, Richard.
Great. So the US labour force participation rate is continuing to rise after its pre-COVID slump, and it's sort of back roughly to where it was pre-COVID. At least it's getting there. It appears to be getting there. And the US unemployment rate staying very, very low, 3.7%, 3.8%, where it's been for the last year and a half. And the US U6 unemployment rate, which includes total unemployed, underemployed, marginally attached, and discouraged workers. So it's a bit of a lock, stock, and barrel calculation. And that is also low and rising slightly, but nothing significant.
So in my conversation every week with my US fund manager friend, he's been talking about how the unemployment rate and claims for unemployment may be low because these days the amount you get from unemployment in the US is very low. So people, A, don't bother, and B, they can just sign up to drive for Uber. And so they, instead of getting unemployment benefits, they just sign on as a gig economy worker. Hence the switch from full-time to part-time work and the relatively low rise in unemployment.
So basically, the stats system just isn't set up to cope with gig working properly, is it?
Yeah.
Doesn't know what to do with it. US factory orders month on month for December even, 0.2%, which is around about expectations. Now, this is a Christmas period, so presumably that's the reflection of Christmas. Ex-transport month on month, 0.4%, so better than expected.
Decent.
Yeah. Quite a volatile series, that, isn't it? US S&P Global Services PMI, that's the final figure, so above 50, so maintaining growth. And this is the US S&P Global Composite PMI, which is, again, in pretty much the same situation. Slightly worse than expected, but still above 50, looking quite healthy.
Yeah.
No sign of recession there.
Yeah, so the final numbers were revised down slightly.
So the US Services PMI, it is bouncing between 50 and 55 as it's done for the last year or so.
Yeah.
And ISM Services business activity is, so I would say it's fairly stable. It's quite a noisy sort of series, but it's fairly stable over the last 18 months or so. And ISM Services employment after that big dip last month, has bounced straight back up. So it looks like it might be a little bit of a statistical aberration.
Yeah, it doesn't really give you much confidence in the ISM, frankly.
No, it doesn't, does it? I mean, if you look along, there are a few points where, well, it is quite a noisy chart.
Yeah.
There are a few points where it appears to dip down rapidly for a month and then bounces back up. And that's probably a statistical artifact, isn't it? And ISM services new orders, noisy again, but seems to be stable at about 55, the mid 50s.
Yeah.
And ISM services prices paid, that's actually started to look as if prices are going back up, and there's a bit of a trend forming there.
Well, that's concerning, but reminder, the ISM data is very noisy.
Yeah, very true. US consumer credit change, very little change really, 1.5 billion, 1.6 billion.
Yeah.
Which is small in comparison to previous months.
Yeah, very weak, actually. Surprising.
Yeah, I mean, I guess a lot of people maybe did their Christmas shopping in November.
Yeah, that's what it looks like, doesn't it?
Yeah. US used car prices year on year are still falling, but they are falling at a fairly steady rate of about 8% year on year. At some point, they have to level off because otherwise used cars will be free. But
Yes. Yeah.
not there. And the Logistics Managers Index, I mean, this is suggesting that freight shipping isn't slowing down, isn't it, Keith?
Well, that's still actually quite a poor number when you look at history, but, certainly better than it was.
Yeah. Red Book retail sales looking very strong and healthy. 30-year mortgage rate has actually dropped quite sharply, but that drop has just halted for the time being. But it's we need to see more data before we know whether it's going to continue to fall or whether it's sticking around about that 6.8 level. And the NBA mortgage market index starting to show very slight sign of recovery, possibly.
Yeah.
US initial jobless claims is unremarkable.
Yes.
US continuing jobless claims, it's slightly more remarkable in that this hump that started to generate in the autumn of 2023 looks like it's being sustained. And the Dallas Fed weekly economic GDP estimate is the same as last week, 1.7%.
Yeah. No new data, basically.
Yeah. The Atlanta Fed GDP now, 3.4% this week, 4.2% last week. I mean, it's just, I don't know how you can measure GDP on a weekly basis.
Yeah, no, it's an estimate so they get more data in, but 3.4% is, red hot. That's fine.
Yeah. And there's the US Economic Surprise Index, which is showing us, I don't know.
Well, it's strong again. It's, as you say, it's volatile, but it's still currently strong.
Yeah. I mean, it is. It hasn't gone through the zero line on this occasion, has it? Basically, it's sort of bouncing off the zero line, whereas often it chops straight through the zero line.
Yeah.
And Indeed is continuing to report declining job postings, which again is slightly inconsistent with the jobs data, but it's well above the pre-COVID levels still.
Yeah, you remember we did a survey of Indeed job reports around the globe, and there was a general shift upwards in all of them, in particular in some places like Australia. And it seems that actually over the last 3 years, there's just been a general increase in online job postings. So the whole graph has shifted up everywhere generally.
Yeah. Today's US inflation rate by Trueflation, 1.4%, and the US government reported rate, 3.4%. So that's pretty low.
Mm.
The Industrial Production Diffusion Index. So industrial production is around about neutral at 50%, isn't it? Diffusion index is actually showing it's below, not quite well below 50.
Mm.
is sort of hanging around there, isn't it?
Yeah, so basically the PMIs were positive because the people were optimistic about the future. But actually, when you look at activity right now, it's not
Yeah.
great.
So our summary here is that non-farm payrolls for January was very strong, and there are reasons to believe it exaggerates the strength of the job market. We have a section on that a little bit later on. ISM services beat expectations, and it's suggesting recovering strength in US economic activity. Inflation is subdued. There's a spike in the ISM services prices paid index. Maybe there is increasing pricing pressure in the system. And the US economy remains strong and may actually be getting stronger.
Mm. Okay, thank you, Richard. On to China. So we had quarterly GDP growth with Q4, and that came in line with expectations, slightly weaker than Q3. Had the Caixin private sector PMIs, and manufacturing came in flat, unchanged from December, slightly above expectations. Services came in weaker, down at 52.7, still expanding, but not great. And that meant the composite fell slightly. Had inflation numbers, so month on month, there was a rise of 0.3% in January, which is below expectations. But year on year, that meant that deflation got worse. So in the year to January, prices in China fell by 0.8%, and that was below expectations. So China's got deflation. Producer price inflation in January is minus 2.5%. So deflationary forces in China. But loan growth was very strong in January. It's traditionally strong in January, but this was even stronger than last year, and actually the strongest January in this chart. So, is Chinese economic activity going to strengthen from here? The money supply growth was 8.7%, and given you've got deflation, that implies the Chinese economy actually is growing decently well. The Citigroup Economic Surprise Index is minus 9.7. So Chinese economic data generally surprising to the downside still. Now, last week, I was talking about how I wouldn't invest in China because it's very difficult to enforce your rights and none of the Chinese stocks pay dividends. Well, it turns out I was wrong. There is one that pays dividend. It is Alibaba, and the ADR has an annual dividend of $1 and a dividend yield of 1.4%. So if you're going to invest in Chinese stocks, there is one that allows you to get some of your money out. And pause and take a look if you're interested. This is the income statement for Alibaba. It's got a margin of 4%. And thank you to Jaw It for sending that. So in summary, frankly, it's just very difficult to know how much to trust the Chinese economic statistics. We just really don't know how well it's doing. So I was reading a report on Bloomberg saying that they have revised down their fixed asset investment number for 2023 by 7 trillion yuan, or 17%, which is just an absolutely enormous revision downwards. And that was after inspections by statistical law officials revealed problematic data from many of the regional governments. So Rhodium Group estimate that real Chinese GDP growth in 2023 may have been just 1.5%, but lots of other independent research firms have higher numbers. So choose your poison.
I have difficulty believing that Chinese GDP growth is 5.2% official when the property sector is 30% of the economy and is in such dire straits.
Yeah, I agree with that.
It would appear to me that Fathom Consulting, for example, are simply trying to ingratiate themselves with the Chinese. I mean, otherwise, how could they have come up with 7.2%?
Well, we might remember that there was lockdowns in 2022, so they think the Chinese economy bounced back very strongly from lockdowns, and you'll see they have very low numbers for
Well, yes, I
2022.
suppose. Yeah. What was the
Yeah,
Chinese data for? Yeah, so I mean, you have to see their data series, I suppose, don't you?
yeah.
You have to see their data series in order to understand what their growth is from. That's a good point, Keith.
And onto one chart. So coming up later is a small section on the US Senior Loan Origination Officers Survey, which the Fed does once every quarter. And bottom line is that the tightening in bank lending standards has peaked, and the average of the bank's loan officers shows they're still tightening, but a few small proportion of them continue to tighten. And historically, US recessions tend to happen at the peak, around the peak of tightening, which is now past. So actually, it looks increasingly like the US has achieved a soft landing. And frankly, when you look at the economic data, no landing at all. So the US economy is growing at 3.4% according to the Atlanta Fed. Amazing. And that means the Fed is not going to cut rates anytime soon necessarily, despite falling inflation. And when it does cut rates, doesn't need to cut them very far. Reminder, it needs to keep inflation down, but also ensure a good jobs market. It has a dual mandate. And why does it need to cut rates when the economy is doing just fine, frankly? Thank you very much. It'll be concerned that if it cuts rates too far, that inflationary forces return, given the jobs market is already tight. And that has profound implications for asset classes, i.e., bonds get stuffed. So this week, we're not going to be doing sections on the usual watches, recession watch, inflation watch, etc. We had a special request by a viewer, Andy, to do something on repo and reverse repo. And thank you to Mr. C. Peckham for his input on this section. Okay, so what are repo and reverse repo agreements? So a repo agreement is a short-term asset-backed collateralized loan. So what you have is a dealer in government securities sells government bonds to investors while agreeing to buy them back at a higher price later. So somebody with government bonds wants to turn those bonds into cash. And so for short term, he sells them to investors, which are mainly money market funds. And the interest rate he achieves on these very short-term loans, they're generally overnight loans, sets the overnight interest rate. And that is important. We'll come on to that again later. So a repo agreement, bottom line, enables somebody holding government bonds to turn them into cash on a short-term basis. So for the company borrowing the money, it's a repo agreement. They have lent the bond short-term, receiving cash and agreeing to repurchase it later. For the company lending the money, it is a reverse repo agreement. They've agreed to sell the bond at a prearranged price later. So this is the anatomy of the repo market. Pause, take a look. Basically, there are three ways you can achieve a repo agreement. It's either intermediated or it's not. So basically, the market has evolved to either have banks as intermediaries, inter-dealers, or it's evolved to have deals straight between money market funds and hedge funds, etc. Pause, take a look. So repo agreements are generally very short term, so overnight or for a few days, but open repo agreements do exist where there's no fixed maturity to the repo agreement, and the interest rate charged is generally indexed to interest rates, and there is then a premium to those agreements. Now, what are the risks? Well, the risks are the borrower fails to conclude the repurchase, and then the lender is stuck with the security, and his risk is the value of that security is lower than the cash he's lent out. Now, that is addressed by margin calls and over collateralization. Okay, so why is the repo market important? Well, the repo market essentially sets overnight rates, and the Fed needs to ensure that interest rates in the market are the same as its target rates. And so dysfunction in the repo markets can mean that real world financial conditions deviate from the Fed's target policy rates. And this happened in September 2019, when dysfunction in the repo market led to repo rates rising to 300 basis points briefly above the Fed's target range. And what caused that was a confluence of one-off events. So banks were desperate for cash because corporations had to pay their taxes, so they were withdrawing money from banks and also from money market funds. And also there's a lot of government bond issuance, and the settlement date coincided with the tax deadline. And in the background, bank reserves had been drained. So banks needed cash. Money market funds had also money market funds had also seen withdrawals by corporates needing to pay their taxes. And so nobody was willing to lend cash in the repo market. Banks were desperate for cash. Money market funds were reluctant to lend. As a result, the Fed actually had to step in to provide extra liquidity to ensure the smooth working of the repo market. And here you'll see the spread of the repo market above Fed funds. And on September the 17th, it shot up to over 3% above Fed funds rate. Now, note that the dysfunction in the repo market in September 2019 coincided with the Fed's initial attempts at QT, and that had the effect of draining bank reserves. So banks were reluctant to lend and needed in the repo market, and actually needed cash to settle their government bond purchases. Now, recently, the repo facility at the Fed has surged. So money market funds have been parking an awful lot of money with the Fed, although it is being drained again. Why? The fundamental cause is the supplementary leverage ratio in Basel III, which is the bank regulation. And essentially, banks need to keep reserves as a proportion of all their assets. And that has had the effect of making banks rather reluctant to take on large deposits. And so when people put money into money market funds, they can't then put it on deposit at banks and get a decent rate. So instead, they have been parking it at the Fed, and the Fed has been going into the repo market to ensure that repo rates stay in line with its target rates, because otherwise they would tend to fall because there's too much cash. In order to maintain repo rates in line with Fed rates, the Fed has had to essentially pay rates to all the money market funds. Now, QT means that the bank's balance sheet is falling and money market funds are therefore buying bonds and getting a return that way. So you're seeing that the reverse repo facility at the Fed is being drained. So what are the effects of a reduction in the reverse repo facility? So the fall in the reverse repo reflects money market funds needing cash to buy purchases of T-bills. So excess liquidity is falling. As the reverse repo facility is completely drained, the danger is that there's less liquidity in the financial system to purchase the Treasury's huge bond issuances. However, bank reserves are currently between 3 and 3.4 trillion. There doesn't appear to be much shortage of reserves. And also, the Fed has a new standing repo facility which aims to prevent the return of repo market dysfunction. And so there appears to be little danger that lower bank reserves will cause financial market disruption in the way it did in September 2019. But all the commentary I've read suggests that QT, which, reminder, tightens market conditions, is likely to end when the reverse repo facility is fully drained. Pause, take a look, some charts on reverse repo facility and Treasury bond holdings. You'll see that the drawdown in the repo facility coincides with QT. Now, previously, we have shown you this chart, which seemed to show a very strong correlation between the performance of the S&P 500 and market liquidity. Market liquidity being the Fed balance sheet. Reminder, the Fed has bought bonds and given cash to the economy. So a growing Fed balance sheet means pumping liquidity into the market. A declining balance sheet means withdrawing liquidity. Minus the TGA, the Treasury General Account, minus the reverse repo facility. And so chart at the bottom showed a strong link between the S&P 500 and liquidity. But more recently, that relationship seems to have completely broken down. The S&P 500 has gone off to the races, even while liquidity has stalled. And therefore, will the draining of the reverse repo cause the S&P 500 to stall? Answer, I'm not sure. Do you think this relationship is real or not? Richard, any thoughts?
I mean, it's fairly, there's a fairly decent correlation for 3 years, 3.5 years, isn't there, Keith?
Mm.
And the performance of the S&P does seem to be very much liquidity driven. So I suspect there's a good chance it will fall as a result of it.
Okay.
What do you think?
I've got no idea, honestly. I was just like, frankly, this relationship, it seemed to work very well up until mid-2023, but since then it's entirely broken down.
I mean, the other problem is you never know what other facilities the Fed might introduce, because of course they've introduced that banking facility, haven't they? I can't remember what it's called, whereby effectively they're buying treasuries off banks, so they don't have to report losses, and that's a form of QE, I presume.
Well, what you know is the Fed will always step in to kind of support the banking system, etc. And if difficulties with New York Community Bank widen, then it's only going to go one way.
Yeah, and also if anything else crops up, they'll be in there doing whatever they have to do. So it's and whatever they have to do always inevitably results in an increase in liquidity in some way. On to Egypt. So Attacks by Houthi rebels in the Red Sea have led to a 50% drop in traffic through the Red Sea, the Suez Canal, and that chart shows this massive drop. And so Egypt, in 2023, it was running a current account deficit of $4.3 billion with $10.3 billion of revenue from vessels transiting the Suez Canal. So a 50% fall in Suez revenue will roughly double the current account deficit to about $10 billion. Egypt's surrounded by conflict in these various countries, as we know, Gaza, or Israel, Libya, Yemen, and South Sudan. So it's not in a happy place geopolitically. And this is what's happening. The Egyptian government has devalued the Egyptian pound by 70% since 2022 and has turned to the IMF for funding as well. And that's a six-fold devaluation since, let's say, 2010. Georgieva, the IMF chief, is saying she's now very close to a new loan agreement with Egypt, and having borrowed $3 billion from the IMF in December 2022, so they now need a further $7 billion to take it up to a total of $10 billion, which will get them through about another 12 months, Keith, probably.
Don't think it'll get them that long, mate.
So Egypt is in a mess, frankly, as a result of world events. It's already unstable following a military coup in 2013 that removed the country's first democratically elected government. That was a consequence of the Arab Spring, which was, generally speaking, not as successful as people like David Cameron projected as it would be. Still, thank God we got him back, eh?
Yeah.
And it's surrounded by conflicts which obviously destabilize it, which could spill over into its territory, which make it very vulnerable. And it's possible that it could once more descend into an internal conflict and revolution. And that would disrupt further global trade flows, as well as being very unfortunate for the citizens of Egypt. And Egypt really does appear to be not in control of its own destiny, doesn't it, Keith?
Absolutely. Yeah. If the longer disruptions through the Suez Canal continue, then the more it's going to suffer from balance of payments problems, and that literally means food shortages.
Yeah. Yeah. Which means revolution.
Yeah.
Yeah.
Okay, thank you, Richard. And now we have an extended section on non-farm payrolls. And as a preliminary, just going to go through the difference between the household survey and the establishment survey in the US. So every month, the US Bureau of Labor Statistics publishes these two surveys. The household survey is a result of the survey of around 60,000 households in the US, asking them about their employment status. So it's a survey of households. The payroll survey is a survey of businesses and looks at employment, earnings, and hours worked in the non-farm sector. And this is a summary of the differences between the two. If you're interested, please pause and take a look. The key differences are the household survey counts job holders, i.e., it asks people whether they've got a job. And if somebody has got two jobs, they're only counted once as having been in employment. The payroll survey counts the number of jobs. So multiple job holders are counted twice or more if they've got more than two jobs. The household survey samples 60,000 households. Payroll survey samples 120,000 businesses. So the sampling error on the Payroll Survey should be smaller, you would think. Now, the Household Survey includes unincorporated self-employed people, unpaid workers in family businesses, workers in private houses, agricultural workers, which are obviously excluded from non-farm payrolls, and workers on unpaid leave. The payroll survey excludes all the groups listed left except for forestry workers. And it, i.e., only includes workers in paid employment by a non-agricultural business. Now, the two are currently diverging quite sharply. So the red line is employment as measured by the Household Survey. The yellow line is non-farm payrolls, and the blue line is the adjusted Household Survey. So the adjusted Household Survey tries to get non-farm payrolls or non-farm payroll equivalent data series from the Household Survey data. And it does so by subtracting agricultural workers and also multiple job holders. But you'll see the adjusted household employment survey is diverging quite sharply from non-farm payrolls. Now, why are the two diverging? Well, the first possibility is sampling error. The household survey surveys 60,000 workers and extrapolates the data from that to cover total employment. And obviously, there can be a sampling error. In addition, the payroll survey, which produces non-farm payrolls, is re-anchored to actual payrolls data derived from unemployment insurance filings each year for the month of March. So after the re-benchmarking, which has just happened, so data for the year prior to March is revised, as are data for the 9 months following March. Okay. And in the next section, you'll see that the BLS have revised non-farm payrolls for the whole of 2023. Now, the other difference is that the non-farm payrolls uses surveys from businesses, and so they don't add new businesses to the survey for a while, which means new business payrolls are not incorporated into the payroll survey immediately, but come in with a lag. And in order to account for that, the BLS uses a birth-death model to estimate job gains or losses from new business creation or business failures. And when you look at the chart of non-farm payrolls, it is very smooth because there's a big model component to it. And in addition, off-the-books employment is included in the household survey, but not in the payroll survey. And obviously, multiple job holders are counted multiple times in non-farm payrolls, but only once in the household survey. Now, this is the birth-death model for 2023. Now, reminder, it's been anchored to unemployment insurance claims for March, and then afterwards there's an estimate. And so you can see the birth-deaths model is estimating strong new business growth for much of the year, but tailing off more recently. And for January, it was actually estimating a net loss of 121,000 jobs due to business failures, outweighing new business creation. But the birth-death model has the reputation for overestimating new business job creation when the economy is slowing and underestimating it when the economy begins to recover. And, when you look at the non-farm payrolls, it is suspiciously smooth because of the not birth-death model, whereas the household survey is noisier. they're currently diverging. Is there a systematic pattern, i.e., do the two tend to diverge prior to recessions, which is what its reputation would suggest? Well, I'm just not sure that's true. If you just take the difference between the two, it doesn't seem to be much of a systematic pattern there. I would say that the difference between them tends to be quite mean reverting. So one series will tend to be revised to be more like the other one in due course. So in summary, the household and payroll surveys should track each other after adjusting for multiple job holders and non-paid workers, etc., but they're currently diverging. And the payroll survey is currently giving a more optimistic estimate of the strength of the US labour market than does the household survey, which actually shows the number of jobs declining, whereas non-farm payrolls is increasing. We just have to see how the two come back into line. Reminder, last time the household survey actually increased to become much more in line with non-farm payrolls. And that brings us on to the question of how strong is the US labour market? So last Friday, we saw a massive beat in non-farm payrolls. 353,000 jobs created in January versus 180 expected, and the December number was also revised up. So according to non-farm payrolls, the US labour market is strong and jobs growth was broad-based. So non-farm payrolls portraying a US jobs market that is strong and frankly strengthening. Although most of the jobs growth in the past year has been in healthcare and government or leisure, so not in the broad private sector, and particularly not in higher paying jobs in, for example, financial activities or manufacturing. Their jobs growth has been weak. So, according to non-farm payrolls, the total number of people employed in the US hit a new all-time high in January of 157.7 million. But that is all a function of the seasonal adjustment. Every January, the US economy loses jobs, and this January it lost 2.6 million jobs. So the estimate of how much non-farm payrolls beat is a function of how good the seasonal adjustment calculation is. In addition, reminder, every year the BLS re-anchors non-farm payrolls to the March unemployment filings, and it did that in December. And it warned that after the revision, the new January data would not necessarily be comparable with December data. So the revision actually revised down employment estimates for the 10 months to October, as per the chart on the left. November and December were revised up. The net change was minus 1.3 million jobs. Okay? So everyone talks about how non-farm payrolls beat and was revised up in December. They don't talk about how it was revised down for the earlier part of the year. And if you just look at the non-seasonally adjusted non-farm payrolls, well, it doesn't look like January was anything exceptional. It doesn't look like it was a huge beat, which is what the seasonally adjusted data looks like. And Dario Perkins is saying the same thing happened last year, and it appears the seasonal adjustment for non-farm payrolls for January and February is still being distorted by the pandemic. That is all from the payroll survey. As we discussed earlier, the household survey portrays a weaker job sector. And according to the Household Survey, full-time employment fell 63,000 in January. These are seasonally adjusted numbers, and 1.6 million over the last 2 months, sorry, while part-time work rose. And we've also seen a small rise in layoff announcements the last couple of months. And corporates are increasingly talking about layoffs as earnings slow for the 493 companies in the S&P 500, which aren't the Magnificent Seven. The raw data from the US Treasury shows that unemployment payments are surging. Now, I am confused by this data as each week we report continuing unemployment claims and they don't seem particularly elevated, but rolling 30-day average unemployment benefits paid rising sharply. As we reported earlier, job postings on Indeed continue to fall and do not portray a US jobs market that is red hot. And non-seasonally adjusted, again, showing little signs of renewed strength. But Lightcast, on the other hand, which is another online jobs posting tracking company, are reporting that actually job postings rose in January. But again, that is not huge strength. But the Conference Board survey of consumers showed that consumers thought that jobs were easy to get. Although, if that's true, then how come the quits rate is falling so much? Which suggests that job holders are wary of switching. But this is an important chart. The green line shows the percentage of US small businesses planning to raise wages again, and it is rising. So, if that's true, then wage growth will start to surge again in the coming months, and that is very bad news for the Fed and for inflation. But again, we saw hours worked fell sharply. So why would you raise rates if there's not enough work and you're cutting business hours? So there is some contradictory data, basically. And the fall in hours worked means that although hourly earnings are rising, weekly earnings ain't. So hence that strong hourly earnings number we reported earlier is not reflected in weekly earnings. But by all accounts, it remains easy to find a job. So in summary, there's currently a big divergence between the household survey and the payroll survey. Payroll survey, jobs market is strong and strengthening. Household survey, jobs market is weakening. And actually, there's been a big reduction in full-time work and to be replaced in part by part-time work. The US economy is undoubtedly strong, and it's likely that the labor market remains strong and tight, we've seen from the unemployment figures, but also seems that the January payrolls number, non-farm payrolls number, which showed 330,000 jobs created, that is probably an exaggeration. Richard, any thoughts?
No, it's an interesting case, isn't it? I think that whilst you can, I'm guilty of this. You can be a bit cynical about the data. You can be cynical about all the various adjustments that are pretty enormous. You can't get away from the underlying fact that the US economy is growing, is clearly healthy at the moment, and has been relatively unaffected by the interest rates. And
yeah,
I think probably there's the payroll data. It is vulnerable to political manipulation. It is very difficult to ascertain the real numbers. I think it's a statistical nightmare, probably. But all that having been said, when combined with all of the other data, clearly the US economy is healthy, and it's not what I'm trying to say. The fact that it's hard to get a grip on it at times is not seminal. It's could be a bit frustrating. One wishes it was more straightforward, but with the other data that is around, it's you can read through it. So, but it's a very complex process, isn't it? What you've just gone through has illustrated the difficulty in trying to get a real grip on these.
Well, I mean, you'd think that the number of people in jobs would be quite an easy number to calculate, and actually, it's not. I mean, the thing is, these days with all your taxes paid online, you'd think that this is quite easy to work out. You just work out how many people are paying their taxes every month. But it turns out, and we've had this in the UK where, the HMRC payrolls data, you'd think that's an easy number. And then they revise it by absolutely enormous numbers every month.
Yeah. No, it's difficult to understand why. I mean, it's difficult to understand, isn't it? Clearly, it's much more complicated than that. And in some sense, the HMRC coming out with their payrolls data, you think, well, it's going to be definitive. It's actually quite misleading. It clearly isn't definitive. And whether that's because it's very complicated. But yeah, it's very interesting, Keith. Doesn't answer the problem of how do you interpret the data, but at least it shows why it's very difficult to get it right.
Well, but the market has reacted very strongly to the non-farm payrolls number, and I think they're probably overreacting to a number which may yet be revised.
So we're going to have a look at the Senior Loan Origination Officers Survey now. Fewer banks are currently tightening loan standards for commercial and industrial loans, but the net tightening is continuing. So loans to large and middle market firms and loans to small firms, actually at the moment, they're pretty much coincident in terms of the tightness. Fewer banks are also increasing their loan spreads, but the spreads continue to widen. So which is all suggesting, isn't it, Keith, that the lending market is settling down at a sort of new level.
Yeah, absolutely.
Slowly. And this is the graph showing the percentage of respondents reporting stronger demand for commercial and industrial loans. And that is, whilst it's still negative, it is less negative than it was. It went terribly negative in late mid-2023, but it is now a little bit more positive, which suggests that there is starting to be an increased demand for commercial and industrial loans, suggesting that firms are a little bit more confident than they were, but loan demand is still weakening. Fewer banks are now tightening loan standards for commercial real estate loans, but there is still tightening, and they have been tightened very substantially from where they were in, let's say, 2018 to 2020. And CRE loan demand remains weak, which isn't surprising because I think the market's probably, a lot of the market is probably in a very difficult situation at the moment. But mortgage demand remains very weak and it bounced up, it's back down, it's not showing huge recovery. We're saying here that the US housing market is still quite weak in that sense. And of course, if you go back to that mortgage index data that we looked at, that is still right down at the bottom. So consumer credit, percent of domestic respondents tightening standards for consumer loans, that is falling, but they're still being tightened. Respondents reporting increased willingness to make consumer installment loans, that is pretty low and is just climbing very slightly, but there's a lot of reluctance to make loans. And respondents reporting stronger demand for consumer loans is actually negative. So consumers are also reducing their demand for loans, which all suggests that the credit cycle may be bottoming. If it is, then that's good news for the US economy.
Yeah.
If it's not, then the US economy may have a bit further to fall. But if it is bottoming, that would then suggest that US economy is going to pick up from actually where it is now, which is quite a positive place.
Yeah, absolutely. So it's strong, and the US economy is strong and appears to be bottoming. So, that means if the cycle increases from here, then, that has profound implications for asset classes, et cetera, et cetera. Because currently the US equity market is being supported by the Magnificent Seven. But
Yeah,
renewed growth means the whole market rises.
it does. The only tricky thing there is the level of government debt.
Yeah, no, absolutely. So the US economy has been astonishing. And yeah, I've got this completely wrong, obviously, but expecting, high interest rates to kill the economy, and it's just blasted through. Absolutely amazing. And on to the FTSE 100. And thank you to our Discord member, Uncle Tom, for his contribution to this. Now, since the GFC, the FTSE 100, which is the blue bars at the bottom, have massively underperformed both the rest of the world, which is grey, and the S&P 500. And its valuation, as measured by price to book, is now half that of the S&P 500. So the UK is cheap. Now, a lot of this has been driven by regulation and by pension funds liability matching and buying bonds instead of equities. They've been switching out of equities. In 1990s, they had over 50% of their assets in equities, and now they own only about 5% of their assets in equities, and they've moved all that into bonds. So over that period, they have been huge sellers of UK equities. And all that meant that there was a big demand for UK gilts, and the yields on UK gilts fell below those on US treasuries. So, but now UK pension funds have largely finished that shift. They've almost entirely sold their equities. So that selling pressure on the FTSE 100 and UK equities in general should now abate. And does that mean the UK equity market will finally begin to recover some lost ground compared to equity valuations in the rest of the world? You heard it here first. And onto other charts. So only one chart this week, and that is the UN World Food Index, and that has continued to decline, and that's good news for consumers and for inflation everywhere. And on to good news. Now, thank you very much to our Discord member Magnets for sending this, because this is a really great story. So, in the 18th century, archaeologists exploring Pompeii found around 800 scrolls, papyrus scrolls, which had been carbonized by the eruption of Vesuvius. So these scrolls were wrapped up and carbonized in situ. Now, attempting to unravel them as they did in the 19th century in order to try and read them just did not work, resulted in, as you can see on the left here, the total destruction of the scroll. So, in March 2023, archaeologists launched the Vesuvius Challenge, and they released a CT scan of one of the scrolls to the world and offered a $1 million prize to anyone who could decipher it. And here we are, less than a year later, the prize has been claimed by a group who used machine learning to identify ink residues within the CT scan and then create this image of the unraveled scroll. Now, only around 5% of the scroll has yet been read, but it is a previously unknown work by the Greek philosopher Philodemus of the Epicurean school. And that raises the possibility that in due course, all 800 scrolls could be deciphered, and that would transform our knowledge of the ancient world. And this is the winning team. The triumph of youth. And on to equities. So the world equity market had a decent week, up 1%, up 2.5% on the year. The FTSE all share continues to underperform just about everyone, down 0.3%, down 2% year to date. Euro stocks, despite the weakness of the Eurozone economy, up 0.2%, up 1.3% year to date. The S&P 500, just amazing, up another 1.9%, up almost 5% year to date, led by the Nasdaq, up 2.8%, up 5.2% year to date. Russell 2000 continuing to struggle to maintain the 2000 level, up 0.3% on the week, but down 2.3% year to date. The Hang Seng had a big bounce earlier in the week on the back of Chinese regulatory intervention in the form of bond buying of ETFs by state-backed funds. But that rally has faded again and up only 1.4% on the week, down 7.6% year to date. Topics continues to grind higher, 0.7% up on the week, 8% in the year. Bitcoin, amazing, up 7%, up 9% year to date. Sterling fell on the back of dollar strength, on the back of non-farm payrolls. So both the sterling and the dollar down 0.9% on the week. Dollar index surged 1.1%. US economy is doing well. That means interest rate expectations are higher for longer. VIX continues to subside. Amazing. It's amazingly cheap volatility in the US. Now, some charts. Now, last year we did a section on the Kalecki-Levy formula, and reminder that what it says is corporate profits are the flip side of fiscal deficits. And you can see this is a breakdown of US profits and contributions from the different sectors. And you see the growth in the fiscal deficit in the US over the last year has contributed to the growth in corporate profits. And now this year, the US deficit is not expected to grow and is expected to decline slightly. And that means US corporate margins and corporate profit growth should decline. Currently, everyone is bullish about the US stock market, and that is generally a bad sign. Q4 earnings so far have shown that the Magnificent Seven have had revenue growth of about 14% and a 7.5% and a 7.5% rise in margins, while the other 493 companies in the S&P 500 have had sales growth of just 2% and a fall in margins. So hence, you are seeing more CEOs talking about layoffs as their earnings decline. So, and the PE ratio. Okay, so let's talk about the PE valuation of the US stock market, the S&P 500. According to this chart, the PE ratio of the S&P 493 is only 18 times, which actually is not that extraordinary. But according to the FT, the PE ratio of the 493 is 23, which is not cheap. So lots of contradictory opinions on what the PE ratio is, which seems rather basic. And the S&P 500 is way above its exponential trend line. And generally, it can stay above its exponential trend line for years, but ultimately it returns to it. And meanwhile, in Europe, both sales and earnings are surprising to the downside, but the Euro Stoxx 600 continues to do just fine. Now, the US mega cap trend is looking a bit old in the tooth. And when you look at the performance of Nvidia, it can't carry on going exponentially higher forever. All good things must eventually come to an end. As it is for 3 of the Magnificent Seven. So the red line is Apple, Tesla, and Google. The blue line is Nvidia, Meta, Amazon, and Microsoft. You see, so when we talk about the breadth of the US market, it's no longer the Magnificent Seven driving the market higher. It's now just the Magnificent Four. How long can the US market continue rising when the driving force is an ever-dwindling number of companies? So this is an interesting chart. Pause, take a look. And what it purports to show is a model that predicts the 12-year future return of the S&P 500 relative to treasuries. And right now, it's forecasting that US equities are incredibly overvalued and will underperform US 10 years by 8.2% per annum over the next 12 years. And this model would appear to have quite a good track record when the S&P when it estimates that the S&P 500 is very, very overvalued as it is now. And onto commodities. So commodity summary this week: energy strong. Oil rose on the back of continued tensions in the Middle East, particularly Netanyahu really ruling out a ceasefire with Hamas. And so oil is back above $80 a barrel for Brent. Uranium also resumed its upward path. Industrial metals were very weak. Dr. Copper is diagnosing a weak world economy. Precious metal, poor week for gold and silver. Platinum group metals are continuing to decline, dead as a dodo. So energy. So this is Brent, closed the week at 81.25, up 2.9% on the week, up almost 6% year to date. WTI at 71.7, also up 2.6% on the week. Some numbers are specific to the oil market. Well, we have once again another drawdown in US inventories. The US oil market seems undersupplied at the moment. That should be bullish for oil. But US crude production bounced back to its recent high on the back of shale oil wells returning to action after the winter storms. The Baker Hughes rig count was flat. Now, we talked last week about how the electric vehicle revolution is stalling. And in Germany, only around 2% of cars are EVs, and demand for electric vehicles is expected to actually decline by 14% in 2024. Essentially, as soon as you cut the subsidies, so sales fall. And all that means that although sales of electric vehicles are expected to rise globally, they are disappointing. So oil demand will continue. And if you look at global oil inventories, they are falling. That can't continue forever. Bullish oil. That's bullish for oil. Okay, moving on to natural gas. So another weak week for European natural gas, down 4% on the week, down 15% year to date over the last 5 weeks. And that's great news for you, European consumers, and for inflation. Now, disruption in the Red Sea is causing LNG tankers from Qatar to have to go round the Cape of Good Hope And that means that their transit times have doubled, roughly doubled, and that adds cost, but also reduces volumes in that the same tanker takes twice as long to do a round trip. So the volume of gas coming from Qatar will halve. But as we showed earlier, natural gas prices in Europe are weak on the back of warm weather and actually abundant inventory currently. UK natural gas prices fell 4.4% on the week and 16% year to date. That's very good news for UK consumers. US natural gas prices are collapsing after the winter storms, down 10.7%, down 26.5% year to date. That is a very weak number. There is an abundance of gas in the US. Now, in the coming years, there is a lot of new LNG supply coming onto the market. So that should help US natural gas demand and prices, which are very low. But it looks like there'll be a glut near term unless demand picks up. On to coal. Coal had a decent week, up 3.4%, but down almost 18% year to date. Uranium bounced back up to its recent high. The big news in uranium market recently was Kazatomprom, the Kazakhstani producer of uranium, the world's largest, has warned that it's going to be unable to meet its prior 2024 production targets due to a lack of sulfuric acid. Now, reminder, a lot of uranium is produced by in situ acid leaching. So you pump sulfuric acid down into the ground, into uranium-rich deposits. That sulfuric acid dissolves the uranium, and you then suck the liquid back out and extract the uranium. Now, previously, Kazatomprom had been hoping to expand its uranium production, but now is guiding that production is going to be unchanged at between 21,000 and 22,500 tons of uranium in 2024. It has previously stated that in 2025, it hoped to raise production to between 30,500 to 31,500 tons. Now, part of the complication for Kazatomprom, and thank you to the secret fund manager for sending me a video on this, is that its new deposit, which it was hoping to exploit to get to the revised higher production target, has complex geology and is actually more sulfuric acid dependent. So lack of sulfuric acid really calls into question its ability to exploit its latest uranium acid leaching target. And so bottom line, supply from Kazatomprom is not likely to meet expectations or targets in the coming years, unless you get more sulfuric acid. And the background to all this is that countries are slowly returning to nuclear power. This is a chart showing global nuclear energy generation over time. You'll see the massive growth in the 80s, and then really it's leveled off entirely in the 2000s. We're now going to see a return to growth. And on to industrial metals, generally a very poor week. Aluminium down 1.4%, cobalt down 2%, copper very disappointing, down 2.9%, down 4.4% year to date. Chromium falling, down 0.8%, down 4.5% year to date. Iron ore, that bull market in Q3 2023 now appears to be at an end, down 4.1% in the week, down 10% year to date. Lithium actually showing a little bit of sign of life, but well down from its peak. Neodymium, flat, down 10% for the year. Nickel, slowly subsiding, down 1.4% on the week, down 5% year to date. Tin, going nowhere much, down on the week, flat on the year. Ferrovanadium had a bad week. This recent blip up appears to be fading. Zinc, also not a great week. On to precious metals. So gold had an indifferent week and is down 1% on the year. Silver also had a poor week, down 6% year to date. Platinum fading again, down 2.7% on the week, down 9% on the year. All the platinum group metals are basically showing no sign of life. Rhodium subsiding. Palladium just collapsing, down 8% on the week, down 27% year to date. And that steady downwards drift in the chart appears to be intact. Finally, onto rates. So really poor week for bonds on the back of a beat in non-farm payrolls, showing US economic strength, and that means delayed expectations for interest rate rises. And that means delayed expectations for interest rate cuts, and that is bad for bonds. So the whole UK yield curve has shifted up over the course of the last month. Very bad for me. And the same in the US. And this is comparison of the UK and US yield curves actually coming back towards each other a bit. And this is UK 2-year, which seems to be following the US higher. There's actually UK economy, though the PMIs showed some strength, the retail sales are weak and the economic supplies index is weak. So we're just waiting on the UK. We're waiting to see what the latest inflation numbers, reminder that Truflation shows that UK inflation continues to fall. UK 10-year rising sharply after non-farm payrolls. 30-year back to recent highs, terrible for me. US 10-year had a strong bounce after non-farm payrolls. German 10-year bond yields, I mean, really rising after non-farm payrolls, but Eurozone economy seems to be doing quite poorly, and inflation going nowhere. Italy the same, Greece the same. Concluding comments. Well, the big news of the week was US non-farm payrolls, which portrayed a labor market in the US which was strong and strengthening. Now, we have gone through reasons why the non-farm payrolls number for January may be a bit high, but it is undoubtedly true that the US economy is strong, and the latest data shows that it may be bottoming, in which case the strength will only increase from here. Now, there are many reasons to expect the US economy to weaken over the coming months due to high interest rates, the credit cycle and the credit impulse, falling fiscal impulse from the US government. But so far, the US economy has defied all those and continues to show unexpected strength and resilience. And if the US economy has now bottomed, that means profound implications for asset allocations. In particular, it's time to go back to equities, and I've been entirely wrong on my bond trade. And onto my own performance this week. Well, terrible for me. Really terrible trade, terrible year. Probably getting a bit fed up with me talking about how badly I'm doing. It's not much fun. So my bond trade, I've been expecting the rise in interest rates to kill the economy, and both the UK and US economies have been amazingly resilient. Now, inflation is coming down. The danger is that tight labor markets mean that wage growth doesn't come down as much as central banks would like, and so they keep interest rates higher for longer, and that is bad for me. So for me, the big concern is the US. The Bank of England, we'll cover this next week, have put out their forecast for inflation. They show inflation slowing, but above all, UK inflation going below target if UK interest rates stay at 5.25%. So at some stage, the UK will start cutting interest rates because the economy is stagnating at the moment. In the US, it's not clear they will, because the US economy is doing just fine, thank you very much. Now, I have some US bonds. If that continues, then at some stage I need to make hard decisions and close those out at a big loss and move back into equities. I'll be not panicking and not doing anything rash, but, at some stage you have to make the hard decisions. Okay. Thank you all for watching. I hope you're doing better than me. I've completely messed this up for very good reasons. But anyway, thank you all for watching. Please can you press like and subscribe to the channel. Richard has unfortunately got to go back to work. But anyway, I shall say goodbye on his behalf. And so it's goodbye from both Richard and me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.